Welcome to the Iowa Economy Podcast. I'm your host, Chris Conetzkey, president of BPC and publisher of the Business Record. The Iowa Economy Podcast is your place to get the economic insights you need to help your business stay ahead of Iowa's economic curve. On today's show, we've got two fantastic guests that are with us today. With us today is Ann Villamil, University of Iowa Henry D. Tippie Research Fellow in Economics and professor at the university. She's got decades of experience following the economy and the effects here in Iowa, and she's been a frequent guest on Business Record panels. Welcome, Ann.
Thank you.
And we've got a real special treat. We've got Scott Horsley, who is NPR's chief economics correspondent. He reports on the ups and downs in the national economy, as well as the fault lines between booming and busting communities. Welcome, Scott.
Great to be with y'all.
We're going to have an opportunity to hear more from Scott later in the program, and he's going to be joining along here. And frankly, I could probably turn the show over to him, but first, we're going to get a quick snapshot of the economy. And so that means, Ann, you're up. I've asked Ann to get us up to speed on what has been happening in the economy. She's got the easy challenge today of providing 3 economic insights in 3 minutes. So this is the economy in 3, and you're ready to roll.
Thank you, Chris. It's great to be here. So I'm going to talk about the 3 main economic performance indicators: GDP, employment, inflation, and that, of course, relates to monetary policy. They give us an overall sense of what's going on in the economy. So we'll look both at where they are and take a little peek about where some data suggests they're going. So GDP, the news right now is good. The second quarter was strong. GDP rose at a rate of 3.8%, which was up from a decline of half a percent in quarter one. A lot of that was due to tariffs and trade, that decline in the first quarter. And the Atlanta Fed estimates that the third quarter is going to grow similarly robustly. I think that's not a universal view, so we'll talk a bit more about that. The Conference Board Leading Economic Index has been declining, and that's a forward-looking measure. Second important thing to be focused on is employment, and that is mixed. It's currently okay in the sense that the unemployment rate is 4.3%, which by historical standards is a good reading. But there is certainly concern about the future. Labor force participation has been declining, and measures of job openings, as in the so-called JOLTS report, are a bit concerning. Furthermore, there's declining business confidence, and that's concerning because it restrains employment going forward and investment. But actual services and manufacturing data right now is expanding a bit. So that hence the mixed picture. The third thing to look at is inflation and monetary policy. Again, that is mixed. The Fed has a dual mandate. It looks at both inflation and unemployment. And it has noticed, I think as we all have, increased uncertainty, which has gotten worse in the short term due to the government shutdown and the lack of data. And that lack of data is very concerning going forward. So inflation is about currently 3%. It's above the Fed's 2% target, whether measured as all-in, both leading indicators, or core inflation. But the Fed, in its most recent meeting, just cut its policy rate by 1/4 point. So that rate is now in the range of 3.25 to 4. And again, the Fed's dual mandate is to balance inflation and employment. And the Fed judged the risks on employment to be sufficient to lower by 1/4 point. But it also said in its statement, essentially, don't read too much into this. We're going to be looking at the data, and we may cut in the future and we may not. So taken together, the current indicators are okay, but there is uncertainty and concern about the future.
Made you summarize the economy in 3 minutes there. You did a great job. I think you even had a minute maybe to spare if you really wanted to keep going. I'm going to bring Scott back on here because you gave us a lot of string here to unpack. And I think one of the places I'd like to maybe start is you talked about GDP, and I'm curious what's maybe leading to that. I think there's so much noise around challenges in a lot of ways, but then you're saying from a national level, there's still been some expansion. So just curious, maybe what are some of the underlying factors there?
So GDP, 70% of that is consumption, and consumers have continued to consume, though not uniformly. Certainly, if you're in the top 0.5% of the income distribution, you are consuming robustly. Even if you are in the top 20%, you are consuming strongly. For the rest of the population, that's fairly flat. And so we also pay attention to measures of sentiment. And that's part of the concern going forward. The University of Michigan Consumer Sentiment Index was 53.6 in this October. And if the indicator is above 50, the economy is moving forward. If it's below 50, it's starting to contract. So, you might look at that and say, well, it's above 50, and clearly it is. But it was 55 in September, and it was 70 a year ago. So sentiment is slowing down. There's also concern about layoffs. And if you are a new entrant into the labor market, a graduate, you know that this labor market is tough. And then the other side of this is business. Business sentiment is something we also pay attention to because it drives investment and hiring. There's been a lot of uncertainty about tariffs. They affect input costs. There are also concerns about the current shutdown. There are concerns about the workforce, both skilled labor and immigrants who are important in certain sectors, construction, agriculture, hospitality. Health insurance right now is a big issue, and that's about 20% of the economy and will affect people's disposable income. Data indicators are, on the business side, falling a bit. So the ISM manufacturing new orders fell to 48.9, so that's below that 50 threshold. The export order book has fallen 14.1% in September. And the business sentiment that's put out by the Conference Board. It is delayed due to the shutdown, and as many series are, so we've really got to get that data going again. The August readings were a decline of 0.5% of the leading indicators, and current conditions were weekly positive at 0.2%.
Scott, I wonder if you could talk in your reporting, and we'll talk more a little bit about some of the things you do and report on, but I know you're often interacting with folks that would have a good indicator of the sentiment. And I keep kind of coming back to this almost incongruence between, you can see the stock market is continuing to perform great, you see the GDP numbers still up, but then you hear some of these things where sentiment's starting to turn in some places. I'm just curious what you're seeing maybe in that area.
Yeah, well, we're not seeing as much as we'd like to right now. As Ann mentioned, we've been really handicapped this fall by the government shutdown, which has choked off a lot of the official economic data that we would ordinarily rely on to take the temperature of the economy. If the economy, as Ann mentioned, is primarily driven by consumer spending, and we think that's held up fairly well, but we don't have a really good sense because, for example, we haven't gotten some of the fall spending numbers that we would ordinarily get. And of course, what props up a lot of that spending is the job market, and we haven't gotten a lot of the job market numbers that we would ordinarily have at this time. The jobs numbers for September are more than a month overdue now. We would have gotten the October numbers last week, but that's been held up again by the government shutdown. So it's hard to assess how the economy is doing. An economy this big and complicated is doing in the best of times. It's that much more difficult when you don't have the government statistics that you'd ordinarily rely on. But overall, as Ann says, it's a glass half full, glass half empty picture. We think GDP is holding up okay. We should have gotten the third quarter GDP numbers by now. We haven't. The first and second quarter numbers were pretty much distorted by the trade war. We had a huge flow of imports in the first quarter as people rushed to get ahead of the president's tariffs. That made GDP in the first quarter look artificially weak. Then we had a huge flow of imports coming in the second quarter as people. We had a huge drop in imports in the second quarter as those tariffs kicked in. That made GDP look stronger than it really was in the second quarter. And now we're kind of waiting to see how it was in the third quarter. Hopefully, this is kind of normalized a little bit.
Take a guess and throw a dart at the wall right now is what you're saying. It's a good thing we're having an Iowa economy podcast now, where I was hoping there'd be some great data for us. But that's kind of the challenge right now, right?
Absolutely. I mean, Ann talked about the manufacturing numbers, which have really been kind of in the tank for months now because of the trade war. A lot of exporters rely on imports for some of their processes. Manufacturers are supposed to be the beneficiaries of the president's tariffs, but they're screaming bloody murder. Every month that ISM report is full of people complaining about not only the level of the tariffs, but the kind of random way that they kick in. It's very hard to make predictions. That's really hard on manufacturers. And of course, Iowa is a factory intensive state. And then, agriculture, it's been the trade war has been terrible for farmers. It's both raised the cost of their fertilizer and other inputs, and it has depressed the price of their product. We had a terrific corn and soybean harvest this year, not only in Iowa, but across the country. Unfortunately, it was so good that the prices, I don't have to tell your listeners, the prices are terrible. And so, huge harvest, losing money on every bushel. That's really tough. Some good news did come out of the president's recent meeting with Xi Jinping. It looks like China is going to at least end its boycott of U.S. soybeans, which has been terrible for your listeners and farmers in Iowa and throughout the Midwest. But all that's doing is getting us back to where we were before the trade war started. And frankly, I lived through this in the first Trump administration. China doesn't always come through on all these sales commitments. So I kind of believe those purchase orders when I see them.
And when we talk about GDP, we're talking nationally. Do you have any insight into Iowa's specific performance in that way?
Well, as Scott said, Iowa's taking it on the chin. Agriculture, manufacturing, even financial services. Those are three key sectors in Iowa, and they are hurting. So unemployment is actually going up. GDP in Iowa has been mildly negative. So that is concerning. And I couldn't agree with Scott more about the trade war has been very, very damaging for Iowa. And most ironically, in sectors that it was designed to support, like manufacturing. If we just think about a country like Canada, our big three trading partners are Mexico, Canada, and then China. Right? And we don't have trade agreements, or I guess I should say new trade agreements with Canada and Mexico. As a matter of fact, we keep, another 10% on Canada because we didn't like an ad, which is very, very concerning. And, why am I saying this? We with Canada, we actually import a lot of inputs. So aluminum, steel. Scott talked about components for fertilizer. And so when we impose those increasing tariffs on Canada, we are raising the prices for U.S. firms inputs. So it's, you know, a very concerning situation.
I'm going to switch gears just a little bit into workforce, and then we've got a question for Ask an Economist from one of our audience members as well. But I want to go to workforce, and maybe Ann, if you could talk a little bit about here in Iowa again. I'm not going to get the statistic right at the moment, but I believe Iowa is one of the few states that has not had employment growth, and I imagine that's connected into some of the things we're talking about as it relates to manufacturing. I wonder if you could talk a little bit about workforce here specifically in Iowa.
Yes. So employment, again, agriculture, manufacturing, and financial services. Iowa has been shedding jobs, and that's concerning. So Iowa's unemployment rate usually lags the U.S. It's a bit below it. And it's a bit above it. It's a bit above 4% now. So that is very concerning for people in Iowa.
Scott, when you were working on the story about farmers and some of the effect there, and just curious what maybe you're seeing from an employment standpoint, maybe not just to Iowa, but for Midwest states that are really being hit by some of this.
Yeah, I mean, in terms of the agricultural sector in Iowa, it's not super labor intensive. It's enormously mechanized and incredibly efficient. So the demand for farm labor in Iowa is not as high as it might be in a place that was more, say, dairy intensive or something like that. But there's no question that, the farm workforce has been challenged nationally by the president's crackdown on immigration. 40% of the agricultural workforce nationwide is undocumented, and that's especially tough for some of the crops, specialty crops that are more labor intensive. It's very challenging for the dairy sector, which can't, for example, rely on seasonal visa holders to come in because cows don't give milk seasonally; they give milk all year round. And I talked to a farm labor expert in New York who said a lot of farmers there are concerned that if some of their workers are deported, they don't have a plan B. Plan B is to sell off the cows and fold the farm. So that's really difficult. In terms of the workforce overall, not just agriculturally, but one of the questions that we have is there's been a very significant slowdown in hiring, at least through the month of August, which is the last month that we have good data for. But the hiring in July and August was much slower than it was at the beginning of the year. We actually saw a net loss of jobs nationwide in June. How much of that is because employers want fewer workers, and how much is because employers can't find the workers that they do want? We've had both a drop in the supply of labor because of the immigration crackdown, and because we've got an aging population, especially true in Iowa. Nationwide, 10,000 baby boomers are retiring every day. So we've got a workforce that's barely growing or actually shrinking. At the same time, we think we have employers demanding fewer workers, and how much those two pieces, the supply and demand piece, are driving that slowdown in employment. That's one of the questions that the Federal Reserve is wrestling with as they try to figure out how worried should we be? That is, if employment if employment growth goes to zero, is that going to cause a big run up in the unemployment rate, or is that basically just keeping pace with our kind of stagnant workforce right now? In which case, it's still not great, but it's not as worrisome. And we just really don't know. We have had some high profile layoff announcements. Some big companies have announced big job cuts, but it hasn't really shown up in the weekly unemployment claims. So it doesn't look like there's a huge wave of a big increase in the unemployment rate heading our way. But it's just tough to know. And again, because we're not getting those most comprehensive monthly snapshots of the Labor Department, we're really driving through a foggy road right now.
Well, I want to switch gears a little bit here and go to our Ask an Economist segment. Thank you each for helping get us a little bit caught up on what is going on. And in a little bit, we'll switch gears and look ahead to the future. But we're not the only ones that have good questions. And just because we're journalists, we don't get to be the only ones to ask questions. Sometimes the best questions come from our audience. And so we've got a great question here for our segment, Ask an Economist, from Dan Keogh. He's the CEO and chairman of Holmes Murphy. And I'm going to ask you to try to give your best to respond to this. And Dan says, tariffs haven't seemed necessarily to increase consumer inflation much this far. Do you see this continuing, or how do you estimate the split? So between exporters, importers, consumers, for who foots the cost of tariffs, both now and looking forward?
So that's a great question. And let me answer it in two parts. The first is that when tariffs are implemented, or any shock to a market, it takes time for that market to react. For tariffs, it's typically about 6 months. So Liberation Day was April 2nd. And so that would put us into October. We should start seeing those effects now. And as Scott and I are both emphasizing, we're not getting data. So this is concerning. This is the time when we would expect to start seeing these changes. So hopefully we're at the point where we would expect to start seeing these things. The second is, who bears the burden of these tariffs? And there are three possibilities. One is the exporters themselves. President Trump initially said China's going to pay them. The second is businesses in the U.S. So businesses in the U.S. could absorb those tariffs and not pass them on to consumers. And the third is consumers themselves. So given that we would start seeing this about now, we don't know the answer to that question yet. The data is going to tell us that going forward. And that is, in general, when something like a tariff is imposed. This is not a normal state of affairs. The uncertainty regarding tariffs is not anything that I've seen in my life. It is just incredible that we impose a tariff and then we say we're going to wait 30 days, 90 days. Some days it increases by an extraordinary amount. Recently with Canada, again, we didn't like an ad, so we increased tariffs by 10%. This makes it very difficult for businesses to plan and to know how this is going to affect the incidence of those tariffs.
Scott, I'd love to bring you back into on this, and just pick at this just a little bit more. It's something where I'm not sure that I'm always super sensitive to the price of milk and things like that. But I will say I was at the grocery store and I went to buy a pot roast because it was getting a little chilly here in Iowa, and I saw the price and I did not buy it. And it's not because I couldn't buy the pot roast, but it just fundamentally, it was going to be 20 something bucks for a 1.5 pound thing. And so that was maybe one of the first times I've actually had a cognizant reaction to that. I'm curious maybe what you're seeing, even though we might not have the data.
I said a few minutes ago that farmers were really suffering from low prices. I should have said, but most farmers are suffering from really low prices. The exception to that is ranchers. Cattle ranchers are having a great year. Beef prices are quite high. And at the same time, if they're feeding their cattle corn, the corn prices are low. So they've got lower cost and bigger revenue. So the cattle ranchers are carve out from the generally grim farm economy right now. And that's all because a few years ago, when we had drought across the country, cattle ranchers culled their herds. And so we've got the smallest beef herd in the nation right now that we've had in something like 75 years. Demand for beef has remained pretty high, even with those high prices. And so we're seeing market forces at play there. But most of our beef is domestic. There's been some talk about bringing in Argentine beef to support that supply or something like that. But most of our beef is domestic. 0% of our bananas are domestic. 0% of our coffee is produced domestically. We are utterly dependent on imports for a lot of the things, not a lot, but some of our key groceries. Almost all of our avocados come from Mexico. And the U.S. government is now assessing significant taxes on all of that imported food, along with all of our imported clothing and our imported furniture and our imported metals. So, if the government is collecting, as they are, some $30 billion in tariff revenue every month, somebody's paying that. Now, it's possible that in some cases, the exporters in other countries are cutting their prices and absorbing a little bit of that. But most of the evidence thus far is that the lion's share of that cost is being paid by U.S. importers. And in some cases, it's then being passed on to the consumer. I've talked to an awful lot of importers who say, I don't know who thinks that the foreign suppliers are paying those bills, but I tell you, I'm the one that writes the check to get the merchandise out of the customs warehouse. I'm paying it for now, and if I can, I'll pass it on to the end consumers. I think the consensus view of most of the economists I've talked to is that about a third of the cost, so about a third of what's going to ultimately be the tariff cost, is showing up in consumer prices so far. More to come. So more price hikes in the pipeline there that will show up in at the retail level. And we are seeing some. We did get one piece of data for September. We got the inflation data for September. The Labor Department had to call some workers back especially to do that because that's part of the formula used to calculate the Social Security cost of living adjustment. So that was one piece of data. Nobody was going to tick off 75 million Social Security recipients and not have their COLA next year. So they did bring some workers back to do the CPI, the Consumer Price Index for September. And we know that was 3%, a bigger annual increase than the month before. What's driving that? It's higher cost of imported goods, things like apparel, things like furniture. Now, it could be higher still, but luckily we've gotten some relief in some other components of inflation, like housing. So it's not that, we're not going to go back to the bad old days of 2022 with 9% inflation, but we are seeing inflation that's higher than it would otherwise be as a result of these tariffs. And just one more wrinkle there. Last week, the Supreme Court held a hearing on a legal challenge to a big chunk of these tariffs, not all the tariffs, but a lot of the tariffs, but about more than half of the tariffs have been authorized under this 1970s Emergency Act, which never uses the word tariff. So there's a legal challenge that's pending to that. And if, depending on how the court rules in that case, a lot of these tariffs could go away. Just one more question mark for people trying to make an annual plan. Very difficult time for business people.
And it's an open question. But even those tariffs, you pointed out about collecting revenue. Potentially, those revenues could need to be rebated.
Oh yeah. The government may have to refund all that money. The administration, in their legal briefs, have painted that as sort of a catastrophic fiscal situation for the country. But let's remember, we weren't assessing anything like those tariffs in January before Trump came back into office. So, if those tariffs go away, it would basically mean just going back to where we were, a year ago, which is not a great fiscal situation for the federal government, but it wouldn't be catastrophic.
Well, Scott, I want to get a chance to get to know you a little bit better, too, and have our audience get to know you. A mutual friend of ours and a coworker of mine, Michael Moraine, helped make the connection here today. And so would you mind just sharing a little bit about your background also today and a little bit how you got into the role that you're in?
Sure. Well, I started working in radio when I was in high school and thought someday I would have to get a real job. And I've been doing it now for 30 plus years and haven't had to get a real job yet. So I've been very fortunate. And I was lucky to meet Michael Moraine back in 2013 when some colleagues of mine and I decided we would join 10,000 of our closest friends and bicycle across Iowa in the Register's annual Great Ride Across Iowa, which we also thought that was going to be a one-time thing. We'd spent a lot of time covering politics in Iowa and wanted to see a different side of the state. And we had so much fun. We've done RAGBRAI every year since. So we call our team No Pie Refused, or NPR for short.
some fantastic pies into the office. It's pretty much the reason we keep them around here. So you've been covering you've been covering the economy for a long time, and as you've alluded to, there's been a lot of differences in the challenges with data right now. And maybe just if we zoom back out a little bit, what has been different about your attempt to continue to cover the economy during this administration?
I was covering the White House right after the great financial crisis, and in those days, we sort of had an administration that was trying to respond to a lot of external forces. Whether the collapse of the subprime mortgage market, and General Motors and Chrysler sort of teetering on the edge of bankruptcy. The difference in the current environment is that we sort of came into a more or less stable situation, and then we had the administration itself generate a lot of the uncertainty and a lot of the chaos. So that's certainly one part of the challenge, is that the many of the unexpected events that have happened in both in the Trump first administration and again now are sort of the result of actions that have been taken by the administration. You might support those actions, you might oppose those actions, but they are stirring the pot themselves. It's not a rain cloud that's come in from outside. Obviously, the pandemic in the first Trump administration was an external event, but most of the uncertainty in the economy that I cover now is being generated by the administration itself, and then how other countries and then how business people try to react to that.
One of the things that we found our team, our newsroom, challenged with, especially in the very early days, was that because the pace is happening on a variety of different fronts, trying to choose what and where to put resource towards covering can be a real challenge. And you could start down the path and then something changes the next day. I wonder what your approach has kind of been, and NPR's approach in that. We've tried to go, let's find something that we can provide at least some information on and continue to provide that. But actually, we've tried to slow down a little bit and not try to chase everything that's happening. I'm curious what your approach has been.
Yeah, you do. I mean, every day the administration will send a shiny object into the atmosphere that you can spin your wheels covering. We try to stay focused on the things that really matter to people, that are going to make a real difference, either positively or negative for the economy. And Ann and I've talked a lot about the lack of official data, but the data just is just numbers. The real stories are when you go out and you talk to people, whether it's a farmer in Iowa, or a manufacturer, or an importer, or a consumer. I've been talking recently with some people about the housing market, which has been very challenging. It's housing is a whole lot more affordable in much of Iowa than it is in other parts of the country, but it's still pricey in Iowa, a lot pricier than it used to be. And that's a challenge for families, especially those trying to break into the housing market for the first time. And so when you hear those stories, it certainly helps to put some meat on the bone. The numbers will give you the skeleton, but the meat on the bones really comes from going out and talking to people.
Are there some stories you wish you could go dive into a little bit more and get some more information on it? Maybe I'm sure you're not Superman, can't be on every single story all the time, but curious if there's some things that you're curious about that you haven't had a chance to get into yet.
Oh, yes. And people are always suggesting stories, and you kind of have to triage that. One of the things I'm interested in is I was talking to a wine importer, for example. And, one of the challenges with these tariffs, for example, is it really affects his cash flow. He says, if I bring in a container of wine from Europe that, let's say it's going to retail for $100,000, I've got to pay a tariff. At that time, it was a 20% tariff on European imports. He says, I've got to come up with $20,000 to spring that wine from the customs agents before I've sold the first bottle. In other words, I haven't made $1 off that, and I've got to come up with $20,000. Well, think about that for every retailer, every importer of whatever kind of product it might be. And I was talking with some retailers recently, and in our economy, there's always going to be some credit suppliers who are willing to take advantage of that situation. Say, hey, I can loan you the $20,000 to spring your wine or whatever it might be. Oh, by the way, the interest rate is going to be astronomical. there are always going to be factors who will come in and help to grease those wheels, but they may do it in a way that becomes very challenging for a lot of businesses. So that's one of the stories we're looking into right now, is some of those retail creditors who are sensing an opportunity in the cash flow challenges of people who are having to pay these very high tariffs.
Well, Scott, I appreciate getting to know you a little bit better. We're going to bring Ann back on and turn our lens a little bit more to the future here. So I've asked both Ann and Scott to give us kind of a 1 minute, what's something you're watching in the future that we should be an indicator or a trend that you think business leaders should be concerned about or worried about, at least watching going forward. So Ann, I'm going to have you go first, and then we'll have Scott chime in after that.
Uncertainty. By any measure, you can look at it in the press, uncertainty is high and unprecedented. And I think Scott did a good point of saying it's self-inflicted. We have got to start reducing that uncertainty by having a set of policies that we explain, stick to, and implement. And that's certainly the case for tariffs. But it's the case for many other things. If we look at health insurance now, there's just a tremendous amount of uncertainty with respect to what health insurance is going to look like. Healthcare as a sector is 20% of GDP almost. These are big numbers, and we've got to start having policies. I think the initial argument was, well, with tariffs, we're going to say these things because we're going to negotiate agreements. We need agreements that are actually negotiated, signed, and then implemented.
Fantastic, Ann. And Scott will bring you back and give you a chance to give something that we should be watching in the future.
Well, we've talked a little about GDP. We're waiting to see what's going to happen with GDP. Of course, the productive capacity of the economy is dependent on the population and on productivity. We have seen a significant slowdown in population growth. We know the demographics of our native-born population are growing slowly and could even start to shrink. We have been relying on immigration to kind of close that gap and to keep the population growing. Those immigration trends have now changed, and we'll see if that reverses. But unless we see some sort of spurt from productivity, and it's possible that AI or other factors will help us to boost our productivity, but unless we can make up in productivity what we're losing in population growth, then we are in for a substantially slower period of economic growth going forward, long term.
Bring Ann back on as well, and I think this uncertainty question, that's the big challenge, because the reality is businesses hate uncertainty. I'm trying to plan for next year and thinking about wage increases and trying to think about what we're going to invest in next year. And on one hand, because you don't have that data, it's really hard to say, yes, I really do need to be constrained in thinking about it. On the other hand, I don't really feel great about just going crazy and saying, let's invest like crazy. So that puts me in kind of this middle zone. I imagine that's got to have an effect ultimately on what next year will look like, right?
Yes, it affects investment. Investment is, by its very nature, a forward-looking long-term process. And so if there is a lot of uncertainty, firms sit on their hands. So that's concerning. And they are trying to kind of get more out of existing workers. And we'll sort of see how long that can last. If productivity increases, that will be great. And it really would help us a lot. But all of this very much remains to be seen.
A lot of those larger corporations that have been laying folks off, Amazon just announced a big round. I know a few others have as well. So perhaps maybe outside of the direct manufacturing lens of things, the language that I think has been around it has been about making the team more efficient and optimizing and things of that nature. It almost seems like everybody's got the same consultant giving them the language there. I think people are going, well, is this AI? What's behind this kind of thing? I'm just curious, maybe if either of you have some insight into what might be going on there.
Well, we did see some productivity gains. The productivity numbers are very volatile, and they can be. Early in the pandemic, when firms cut millions of workers, we saw productivity go up. That's a little bit of an artificial thing where you're just milking more work out of the workers that were there. But we did see a little productivity boost as people return to work post pandemic. And one theory of that, there are a couple of factors that contributed to that. One was firms did find ways to do more with less. We saw that when the service, some of the restaurants and so forth had to get by with fewer wait staff, they did find some efficiencies in how to deal with that. So there was some of that. But there was also a theory that when people shuffled during the Great Job Shuffle, people did find jobs that were better fits for them, and so there was a better match between employers and employees. Now we're not in that shuffle situation anymore. In fact, we've got the opposite. There's very little churn in the workforce right now. Nobody wants to leave a job because they don't feel like there's a lot of jobs out there, and so that little boost we saw in productivity as there was a lot of churn in the workforce. We could see the opposite of that now, where people stick around in jobs that they're not happy in and maybe not particularly well suited for. And that could be a real challenge for us.
I've had a theory that I kind of keep throwing out there for folks and let them chew on it a little bit, but that with all that transition and change and some of the demographic changes, it just takes longer to do business in some cases when you're doing business with new people. And so I think about some of the effects that you mentioned during the pandemic, but also just that with demographic shifts at top leadership position, if I don't know the person I'm doing business, or I have a vendor that I had been doing business with, and I think some of that is just, I think that's behind some of what has happened over the last few years. And because I kept getting stuck on that productivity thing, we've got things like AI and everybody's going, we'll be more productive. And yet you hadn't really seen that metric moving in quite that way.
Yeah, AI firms are not quite sure how they're going to use it, right? So there's this tremendous sense that this could be a great opportunity. And this idea that we have less workers, well, if they can be assisted by certain tools, that could be great, but we haven't seen it yet. And this is actually common in technological innovations. We have something new. We're not quite sure how we're going to implement it and how that technology is going to be disseminated. So, again, part of that is standard for a big technological breakthrough, but it remains, we don't know. And you had started at the outset with the market. Yeah, the market's up, but it's a very narrow set of firms, and that is concerning.
And you're alluding to specifically AI firms as being a key component of that?
Yes, 7 big tech firms, right? If you look at the indexes, they have had, in some cases, meteoric rises, but historically we have seen meteoric falls. So that's concerning.
Is it the meteor that wipes out the dinosaurs?
Yeah. Well, and I think I
say that as a guy who once raced a news writing robot and had my typewriter clean. So
I just got back from a conference. We have an Association of Business Journals, and one of the publications they built a first line editor that uses their voice. And now they're not saving. It's not replacing jobs. It's essentially the way they've described it is it's something that they weren't able to do beforehand that is now able to help ask some critical questions on the front end before their human editor is actually getting to that piece. So it was really interesting because, that might improve the quality of something, but it wasn't necessarily increasing the time. And in fact, it was actually probably delaying the process in some ways, but making for a better product, which I thought was just an interesting way maybe to think about some of the AI stuff too.
Yeah, it takes time to learn how to understand a new technology and learn how to implement it effectively. I mean, in general, I think this could be great, but more uncertainty.
Well, I'm going to push the lens out a little bit here as we get close on time. And just if you're looking out a year from now, and I realize that feels really far away because, and in fact, I always kind of joke, we do an economic forecast event, and that's usually a question I ask. And when the relative underpinnings are kind of steady, it's a fun question to ask, but it feels like everybody's face is a little bit closer to whatever's happening right now. So if I push it out about a year, what's something that maybe you think we might be talking about at that time? And let's see which lucky one of you wants to try to go first at that.
The U.S. economy is strong and dynamic, so that's the good thing. I hope that we will continue to see GDP growth, but Scott pointed out we need labor, the right kind of labor. That's concerning. And we always need investment, which by its nature is a long-term process. So we've just got to get this uncertainty down. I think it's very difficult to see. And I continue to be concerned about inflation, not 9%, but inflation growing above where we would like it to be. And that will reduce people's real standards of living over time. So that is a concern. So I think it is very difficult to see where we're going to be in a year.
Scott?
Well, I will just say that the current president has been at least asserting a role in the economy unlike anything we have ever seen, whether it is, ordering the tariffs when he wakes up on the wrong side of the bed, or demanding a government stake in a business, or demanding a cut of NVIDIA's sales in China. This is a centralized government role in the economy, unlike anything we have seen before. And a year from now, we are going to have a midterm election. And I think we'll get a reading then on whether people approve of that sort of unilateral exercise of power from the White House in the economy, or if they think we ought to go in a different direction.
As you push the lens out a little bit further like that, it always strikes me that there's when there's so much uncertainty right now, it leads to that inability to plan in some fashion. And so, especially though with the lens of the data component and not actually knowing where you're at. And in some ways, I kept thinking about it like we're in a tunnel where we were able to at least get retroactive data, and now all of a sudden that's kind of shut off. And so if that were to continue, what would the effects look like if we're in a prolonged period of time without having data?
I'm concerned about that because data are a check, right? Like you can make grandiose claims, but at the end of the day, data are imperfect. But when you start seeing multiple types of data pointing in a certain direction, it tells you if you're on the right path or not on the right path. So we do need that data. And that's something that the Fed is very much, they have a dual mandate. They are concerned about employment. They're concerned about inflation. They are both very important.
Yeah, I'll just say too, the lack of data during the government shutdown has been, particularly noticeable and sharp. But even before that, we were seeing efforts by this administration to, chip away at some of the number crunching functions within the government. There were a lot of job cuts in the Bureau of Labor Statistics that does our job tally every month and that calculates the inflation rate every month. And as a result, we were seeing some degradation in their ability to do price checks around the country, for example. We saw the president fire the head of the Bureau of Labor Statistics and try to install a sort of partisan hack in that position. Now that's been rebuffed, but we'll see who winds up running that shop. But yes, there is definitely an effort by this administration to control the flow of information, whether it's from the government itself or whether it's from any independent news organizations or universities or all the other sources of sort of alternative narratives to what's coming from the White House itself. And U.S. government statistical agencies have been the envy of the world there are lots of countries that don't have reliable data the way that we have, and we could certainly find ourselves in that same position.
This is a little bit in the weeds, but just for maybe my own knowledge, the data that we're not collecting right now, will somebody be going backwards to still collect that, or will we end up with a gap in the data?
I think that's a very much an open question right now. For example, we saw the numbers for the September jobs report were collected, but then not released because the release date would have been after the government shutdown. The data that was the raw material for the September inflation report was collected. And as I say, they brought some people back to publish that. I don't even know if they have been doing the price checks for the October inflation report that we would ordinarily be getting in a week or two. And, you can kind of go back and try to reconstruct that. What were you charging in the middle of October for that shirt or whatever? But, the longer it drags on, the harder it is to go back and reconstruct. And at some point, the government may just put a little asterisk in that box and say, oh, yeah, we never got the October numbers, or God forbid, the November numbers, the December numbers. Hopefully it'll wrap up soon.
Well, Ann, Scott, thank you so much today. I know we talked a lot about the uncertainty and some of the challenges, but one of the things that when we are doing things for the business record, we say we try to provide some handholds when there is uncertainty or where there isn't the data, to be able to find some places that you can latch onto and use to try to build the best picture for your business. And so thank you both for helping us do that today, giving just a little bit of a sense of the economy, and again, for providing a peek ahead of the curve of what we might be watching in the months ahead. If you enjoyed today's show, please like and subscribe and tell your colleagues. I firmly believe we're stronger as a community when more people have better information to make better decisions. That's what makes your business better and our community stronger. So thank you for watching, and we'll see you soon.